Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm really excited to be joined by Tom Tzitzouris. Tom is a managing director and head of fixed income research at the firm. Tom, how are you doing today?
I'm doing great. It's a pleasure to be here.
Thrilled to be able to chat with you. A lot of data to parse just in the last week or so. So just this week, we've got some softer than expected inflation data out of a couple key reports, including headline and core CPI. But also at the end of last week, we got a labor market update that showed for the first time in over a year, jobs added to the economy missed expectations. So a little bit softer there, causing a little bit of concern about whether cracks in that labor market are starting to appear. And I guess I'd love your insight on, when taking it all together, how does it impact the when, where, and how deep of your recession call over the next couple of years?
Yeah, and really the two data points that matter the most to markets were last Friday's jobs report and yesterday's CPI report. This morning also we had a producer price index report. All three of those reports have indicated that there has been a further disinflation in the U.S. economy, which is not a surprise. Fed policy is working with a lag. But also, a part of the reason why there's been a disinflation is that just simply year-over-year effects or base effects, where really strong inflationary data from 2022 is now rolling off. So the market's reaction to this has been very aggressive. You've seen equity markets rallying, you've seen bond yields pushing lower, all on the view that this means the Fed's job is probably coming to an end here in the tightening campaign. And although we would agree with that, this doesn't mean, one, mission accomplished, and two, it doesn't mean that the longer term inflationary trends are going to subside. On that first point, we do see the Fed continuing to tighten at least another 25 basis points this year. And as economic data filters in next month, there's a very good chance that we get another 25 basis point hike after that, although the market is beginning to fade those odds of a September rate hike. But looking longer term here, we're still looking at an environment where inflation is not necessarily neutralized. You could see inflation reaccelerate in the second half of this year or early next year if the Fed pauses too soon, or if the Fed begins to cut rates, because the longer term inflationary trends are still in place, in our opinion. And you can see that by the fact that the labor market, although it's showing some signs of slowing, nonetheless, it really is in a very tight market where employers are having a hard time finding staff to fill positions. And that means that wages are going to remain fairly strong for some time. So the inertia in the labor market should continue to put upward pressure on inflation, even though we're in a disinflationary phase right now. So to make a long story short, the markets, both bond markets and equity markets, are looking at this data and kind of signaling a mission accomplished and all clear. And we think it's a little too soon to be doing that.
Yeah, I think so. And to your point about the Fed, I think the market has been discounting the Fed's willingness and ability to raise rates to the level that they have for most of this cycle. And yet here we are at a Fed funds, at 5% or higher, and obviously taking short rates with it. Moving out the curve, I think what I'm most curious about is how this collection of data and how the Fed's intentions affect your outlook for the 10-year Treasury yield. Obviously, a really important benchmark rate, affecting everything from mortgages and other things throughout the economy. So if you wouldn't mind, what's your outlook for the 10-year in the near term and maybe out into the future a little bit farther as well?
So if you combine the disinflationary data on the price side with the labor market data, which is showing a slowing in the labor market, we do think that the U.S. is very likely to hit a recession still before the end of this year or early next year. And that does suggest that 10-year yields should drift lower. And we do think there's a very good chance that we make another push back down towards the year-to-date lows we hit on 10s, which is around a 325. That probably now is not going to happen before the end of the third quarter, but it could happen before the end of the year or early next year. That is a drift down to that 3.25% level. That would obviously bring 30-year mortgage rates probably down about another 60 to 80 basis points as well. But that very well could be where we bottom, because if there is a recession in the U.S., it's probably going to be a shallow recession, and we're still of the view that there's nothing that would indicate that this should be a deep recession if and when it hits. And a shallow recession probably doesn't bring those structural longer-term inflationary pressures, doesn't bring those to a heel, and you probably do see 10-year Treasury yields bottom around a 3 to 3.25%. So we're still looking for that to happen, but candidly, the labor market continues to push back. It's slowing, but it is not rolling over. And as a consequence, any expectations of a recession have to be pushed back to the end of this year or early next year at this point. And with that, the drop in treasury yields is probably also going to continue to be delayed into the future.
Well, Tom, that's tremendous insight. I think paints a really good picture of, again, kind of a unique moment that we're in right now. So thank you so much for the time, and hopefully we'll get a chance to talk to you again soon.
Thank you.